Morning, everybody, and welcome to this top 7 tax-free structuring tips webinar in lockdown. And it's presented by me, Paul Davison. I'm the director of PD Tax Consultants. We're based in Leeds. We also have an office in Manchester. I've been a tax professional for a long time. And PD Tax has just celebrated its 8th birthday, so that time's really flown by, and I've enjoyed every minute. Today we've got Amy assisting us with questions at the end, and as ever, these slides don't constitute advice. So we're going to try and finish at 10 o'clock. Your mics won't be enabled, so you can say whatever you want to say. I won't hear you. But please do send your questions in to Amy via the Q&A button. We're going to be limited to the number of questions raised, so please get them in as soon as you can. There's going to be a poll in the middle as ever. This time it's about the budget and what people might be expecting. And if your question is not answered at the end of the seminar, we will contact you afterwards to discuss what you were thinking about at the time. Okay, there's going to be 7 items to go through, 7 tax restructuring items, just things that we've sort of gained knowledge of and experience of over the years. So we're going to be, because it's 7, we have to be as succinct as possible and just sort of give you the flavours and sort of the benefits and the pitfalls. So you might not understand it to your liking. You know, if one particular item really interests you, you might think, well, I'm not quite sure about this, not quite sure about that. Obviously, you can call us or chat through anything with us after the webinar. But hopefully there'll be one thing, something for you to consider, and you can follow up on those things. And if everybody learns one thing today, then I'll be a happy man tonight. So, on to the first one. Nice, easy one. The insertion of a holding company. Classic trading company, going along, bobbing along, and we start to develop some assets in there. We get some cash, we get some property, maybe there's some intellectual property, and that sits in the trading company. But what happens if the trading company goes bust? We lose all those lovely fixed assets. So one of the probably the main reason for having a holding company is point number 1 there, which is to protect assets. We put the holding company in and we move the assets up via a dividend, and then those assets are protected if we do things properly. The second reason for having a holding company could be to manage the flow of dividends up to the shareholders, especially if we've got more than one shareholder, 2 independent people who own 50-50, say. If they each have their own share, their own holding company, we can move dividends up 50-50 to those holding companies, and then they can decide what to do with those holding companies themselves. They can manage their dividends to keep below the £50,000 threshold for basic rate tax, or start to invest in that holding company, or whatever they want to do. So to get a holding company into place, we really need to do a share-for-share exchange, classic share-for-share, whereas the shareholders of TradeCo give their shares in TradeCo to NewCo, and in exchange, NewCo gives them shares back. That would be a classic share-for-share exchange. But what are the tax issues of that? Well, when the individual gives their shares in TradeCo, that's a disposal of the capital gains tax. And if we can get clearance from HMRC, we can avoid paying tax on that disposal because it's a share-for-share exchange done for bona fide commercial reasons. Now, people who have done these types of things recently will understand that HMRC are getting a bit tighter. They are looking at the reasons for doing it. They're more likely not to clear things like if they think there's a reason for managing dividends. I did get a clearance back yesterday to insert a group company above 2 other companies. And we did get clearance recently for inserting a holding company for protecting assets. But there are certain situations where they're getting a bit tighter. So it's not a shoo-in to get clearance, and we need to be careful about the reasoning. Stamp duty is payable by the holding company on acquiring the shares at 0.5%. So it's not a massive number, it's not a massive percentage, but it can add up. We've got a classic share, we've got a classic mirror, put the holding company on top of the trading company, and we mirror the shareholding in the top company. We should be able to get clearance for that under Section 77 of FA 1986. Although that clearance is actually quite a difficult piece of work in its own right, and the fees for doing the clearance could outweigh the stamp duty. But the question is really, is a holding company right for your client? Sometimes it's not, if they believe it restricts the ability to sell the company in the most tax efficient way down the line. That could be a whole host of things, and I'm not going to go into that much in more detail, but you do need to understand whether there's any ramifications on the long-term plans of inserting the holding company. Okay, that's number one. Number two, we've got a situation where the client's ceasing business, and they've got a decent amount of assets in this company. Should we MVL? Good question. The aim of that is to get those assets out of the company under the CGT regime, perhaps at 10% can qualify for entrepreneurs relief. And we need to understand that getting assets out at 10% of the company is always a chance to be taken if it's available. I suppose what we could also do with the money, if they're thinking about doing some sort of property venture, we could convert that, company into property company, or we could put a holding company above it and then move the cash up and use the holding company as a property company. That way we don't have to pay any more tax on getting the cash out. But if we want it out, 10% is a great rate under the current regime. But as we know, the big consideration here is in relation to the targeted anti-avoidance regime rules, anti-avoidance. And what they mean is that if you carry on a same or similar trade within 2 years of the capital distribution coming out of the MVL, then HMRC will try and say that actually that's a dividend and not a capital treatment. So that needs some care, and the issues tend to be if somebody is doing involved in a similar business, but say they don't control that business, or say it's a little bit different, then it becomes a bit grey, and that's where we need to look at the things in around and decide, can we do something with that other business they're doing to make it a cleaner fit, so to speak. It is subjective though, and there's no case law about this, so that's why it makes it really difficult. But yeah, and if you want to claim entrepreneurs relief, then we need to make sure that we do the MVL within 3 years of the company ceasing to trade to claim entrepreneurs relief. But yeah, MVL is a good way of getting money out at 10%, but careful if they carry on doing something as a business person post capital distribution. Sorry. Number 3, nice one for lockdown. Can you rent your office to your company? Rent tends to be a good way of getting money out of the company, and generally better than salaries and better than dividends, actually, because A, the company gets tax relief for the rent paid, B, we avoid national insurance, and C, the recipients get to offset some of the expenses against the rent, so mortgage interest, does you clean your office, electricity, all those types of things. And as I mentioned there, most people are working from home at least sometime in the moment. So what we do is we tend to suggest that we set up some sort of license arrangement between the company and the individuals. Bear in mind that the landlord is probably going to be this, if it's a home owned by husband and wife, it's going to be joint landlords. So they'll both receive rental income, and they need to go on their personal tax return forms. So to bear that in mind, and maybe you can charge, £300, £500 for the room per month. It depends on what you're doing and the size of the room, etc. A couple of tips there, though, just to make sure that we don't fall into any other sort of tax traps down the line. Make sure to keep something personal in the room. That helps us to avoid any CGT in the future when we sell the property. And business rates would only be payable if you had somebody outside of a sort of an employee of the company who came into work in your house for you. That's when we could have business rates payable. A couple of things there to just look out for, but it is a great way of getting a good rate of tax. Okay, so now we've got a poll. I'll release a poll straight after. I'll release the results straight after we've all voted. And it's about the budget. So, what do people think will happen in the budget on the 3rd of March? Number 1, CGT will stay the same. Number 2, the normal rate of CGT will go up from the 3rd of March. Number 3, the normal rate of CGT will go up from the 6th of April. That's the new tax year end. Entrepreneurs relief will be scrapped, and tax will be made simpler. So, just going to start the poll. So if you can all vote, I'll give you 30 seconds there. I'm not sure the music is working today, I'm afraid. We seem to be having some technical problems with the music. But we've just a little note on the bottom of the screen there, just to let you know that we do have a budget webinar planned on the 5th of March. And we'll tell you some details about that at the end of this session. Great, so that's 30 seconds up. Most of you have voted. I'm going to end polling there. I'll share the results. There's actually quite a interesting level spread there. Most people say that the normal rate of CGT will go up from the 6th of April, not from the 3rd of March. But there's still a lot of people saying it will go up from the 3rd of March. That's interesting. Most people think entrepreneurs relief won't be scrapped, but some think it will be scrapped. And there's one person who thinks that tax will be made simpler. I don't think that's going to happen. Right. Anyway, thank you very much for that. And we'll move on to the next slide, I hope. There we go. Right. Demergers. This is an interesting piece of restructuring and a good tip for people out there looking to, who've got a group or got a company and it's got a few different things in it. Because we can use a demerger to partition off sort of investments from a trade. So if you've got some property in the trade which is making the company sort of feel like an investment company, which might be bad for inheritance tax, might be bad for entrepreneurs relief, doesn't feel right, we can move that property over to another company outside of that group. We can even split off 2 trades into the same ownership, but in different companies. We had one situation whereby a property person had a load of property in a company, and he wanted to develop houses on part of it. So what we did was we partitioned that land off from the main company into a separate company, and that company became a house developer, property developer, and that was all done tax-free. Or we can divide our business or businesses between the shareholders. So You might have 50% owned by A, 50% owned by B, and A wants to take away the umbrella business, and B wants the ice cream business. We can make it such that the ice cream business is wholly owned by B through a demerger, and the umbrella business is wholly owned by A through a demerger. It's a really useful tool, and actually it's more useful than you actually can be used in quite interesting situations to come up with good results where you might not imagine it would work. Liquidation demergers used to be popular, but they were quite complicated because we used to have to involve a liquidator. That was difficult and more fees. So now the capital reduction method is the weapon of choice, and it should be able to achieve most things for you with a bit of care. So yeah, we're going to need the clearance. We're going to need to make sure we've got the steps done exactly right. We're going to need to make sure that the distributions occur properly such that there's no loans outstanding. Sometimes we might have stamp duty payable, especially if we're sort of changing the control slightly or moving the ownership, but it would be a small amount. And one of the bonuses of actually doing the demerger is sometimes if you do it properly, you can get a tax-free uplift in the base cost of fixed assets that are moved during the demerger. That's a useful thing to know and bear in mind. It's just a sort of a sideline of the demerger, and all tax advisors agree it does apply. Nothing aggressive about it. It's just a sideline of doing the demerger. So yeah, demerger is brilliant, but make sure you get your steps right. Make sure you've got your steps bang on correct in terms of the legals and in terms of the accountancy before you go getting the clearance from HMRC, because once you've got the clearance, obviously you don't want to have to go back again and fiddle about. So yeah, demerger is brilliant. MBOs. So what we're talking here really is where the management team or some family members or whoever come in and say, right, the person who's in charge of the company is deciding they want to retire or take a step back. They want to dispose of their shares for cash, if they can, or a loan, or get some collateral for them. We tend to want to do a NewCo route there. So NewCo is where the management team come in. They have set up a new company, and their new company buys some or all of the shares from the exiting shareholder. Obviously, different cases, you can get different situations here whereby somebody's buying in, they might be buying 10%, or they might be buying the whole lot out. Something to bear in mind is that a purchase of own shares is generally going to be difficult, just because of the restrictions, the company's house restrictions around what we can do, how we can do it, and also the tax restrictions of making sure that it's a capital treatment rather than an income treatment are difficult as well. And there's not many times you're going to match these. So be careful with those. NewCo route tends to be easy because you get a lot more flexibility. You can have loans, almost set up the terms, whatever you want. We do need a clearance from HMRC. And I would think about whether we want, if we're going to do a NewCo route, what does the exiting shareholder want? They want loan notes, or do they want deferred consideration? Loan notes it's another asset. So when they're realised under the regime at the time, which could be a higher CGT regime. Deferred consideration is realised under the current rules, but you've got to pay tax up front. So that's quite important at the moment. If you've got any deals on, that's an important consideration. Time's flying on, so I need to really get through these next two. Non-capital shares. This is where we've got cash building up in the trading company, but the owner thinks, well, actually, I'd like to use this money to build up a property portfolio or something like that. We don't want that property portfolio in the trading group. We want it in a separate standalone company. So what we can do is, rather than sort of lend that money across to that standalone company, we could set up PropCo, we call it, with some new shares from Tradeco, and those shares would have rights to vote and rights to dividend, but no rights to capital. So what that means is that the cash can move from Tradeco to PropCo via a dividend through these new shares, and that can be done tax neutrally, so that no loans are built up, as I've mentioned before. And if the Tradeco is sold, because the PropCo doesn't have any participation in receiving proceeds, the individuals who own the trading company will still get to sell their shares and hopefully still get entrepreneurs relief, etc. We do need some care there around this, because if this company's been trading for a while and we've got some value in this company, we need to take some real care about how we issue these shares to PropCo, because they will have some value. Ideally, we'd like some sort of share for share agreement, but we might struggle to get HMRC clearance on that. So we might end up with some sort of valuation consideration and maybe paying a little bit of tax to get it into place. But yeah, I think that's becoming more important. People are thinking, I've got a load of cash in my company, what do I do with it? This could be an option for them. Okay, number 7. Well, number 7's a bit of a, it's cop out, but I knew we'd be a bit short of time. So number 7 is really just a tip, which is take some care. Because if it doesn't feel right what you're doing with your client, it probably isn't. And if you're not quite sure about something when you're doing that planning, make sure to check. Because the types of stuff we're doing today are quite intricate and they need a bit of thinking about, like a demerger. If you don't get the steps right on the demerger, even if you've got clearance from HMRC that it's for bona fide commercial reasons, that clearance doesn't protect you if you've done it wrong and there's a tax charge that hits because of a different piece of legislation. So yeah, when you're doing this type of stuff, take care, and of course, PD Tax is always here to assist you. Right, Amy, are you there?
Yep, I'm here. Can you hear me?
I can hear you. Yes, I can hear you. Do you have any questions?
Yep, right. So firstly, when you say a license regarding home rent, do you mean a kind of rental agreement?
Yeah, that's right. I think we tend to call it a license because a license is a little less formal than a rent agreement, than a lease, so to speak. A little less formal, a little less tying in. So a license to occupy would tend to be the best thing to go with. It's simpler paperwork and less onerous, should I say. So yeah, it's the same sort of thing, yeah. Yes.
If you rent an office to your company, could it have implications for PPR?
Yeah. So during those slides, I think I did mention it. It could have, but if you've got something in the particular room which is used personally, so you've got in that room you've got a rowing machine or a library, a personal library, or something where it's used personally. That room is still used personally, and that means that it won't impact your PPI because it's still being used. It's not being used wholly for business. It's being used partly for business and partly for pleasure. So the guidance and commentary on that is that should be okay as long as you've got something personal in the room. Just looking around my room now. Can't see much, but anyway.
What are your expectations for the budget?
All right. Okay. Yeah, I don't think entrepreneurs relief will be scrapped. Because I think that is a piece of legislation or a relief which does drives positive behaviour. People do work towards that 10% rate, and it's gone down to £1 million now. So it's still £1 million, which is still a lot of money. so it still drives a lot of people towards it. So I don't think they'll scrap that. I think they will put up CGT. I hope they don't put it up to the same as income tax rates, because I think that will make a difference, because then it may stop people from doing things. It may discourage people from selling stuff, or, you know, it could slow down transactions. So, and I've been telling my clients to do things before the budget, just in case they do it on the budget day. But what we know is today is before the budget day, and it's before the 6th of April. If we do it between the budget day and the 6th of April, we could end up, you know. So I think it's, in terms of CG, obviously that's just CGT. Obviously they need to put tax up, but it's a difficult thing. We could put tax up on, they could put the higher rates of income tax up. That'll be a simple thing to do. Could put VAT up. Probably less likely. They could make pensions less attractive, because pensions really are very attractive at the moment still. We could change that. That's my thoughts.
Thank you. And then, how much rent can you charge on the license to rent?
I think it's just really a question of sort of, can you benchmark it? So, as an example, you know, we had before lockdown came, we had a room in a serviced office building in town, and we were paying about, that was probably 3 times the size of this room, and we were paying sort of £900 a month for that. So, you know, I think somewhere, obviously it depends on the size of the room, what the landlord's providing. Are they providing desks? Are they providing things like that? Is there coffee and tea? You know, all these things may mean that it becomes more of a place to work, and, you know, who knows, but somewhere between 300 and sort of 600, if it's going to be a nice sizable room, I think that's probably going to be fair enough. But obviously you've got to take it case by case and benchmark it wherever you can, really.
Yeah.
One more question, Amy, I think. 2 minutes to go.
It's another one about home office.
Seems very popular, that one.
Yeah. Regarding keeping something personal in the room, do you recommend declaring a small private use of home office percentage on the individual's SA 100?
I don't think that's relevant, because what we're doing with the license is we're licensing it to the we're licensing the room to the company for working hours. So we're not, there's no benefit in kind in relation to that benefit received. It's purely just that I'm sat here today and PD Tax is using this room for its business. If I was not in lockdown, I'd probably be in the office and doing the webinar from a meeting room. So, you know, PD Tax Consultants Limited is, I'm not saying that I do this, but PD Tax Consultants Limited is using this room, and it's paying a fair rate for it. So the fact there's no personal gain by me, so I don't think I'll put anything on my personal tax return about it. I think some people can get mixed up between, like, a sole trader using their home for the business, or a limited company. A sole trader is if a person owns a house and is that sole trader, then you can claim a percentage of costs for business use. Whereas a company is different to the landlord. That's why I have the license agreement. Okay, should we wrap it up there?
Yes, thank you, Paul.
Just time to plug the budget webinar on the 5th of March at 9:30. We'll send out some invites after this email.
You and Vicky.
Me and Vicky are doing that, yeah. I'll be talking about the business tax, and Vicky will be talking about the private tax stuff. Don't forget to ask us about our tax partner service for accountants, or call us under the tax sounding board, or call us for a chat. Happy to talk to you about tax. Okay, thanks very much, and have a nice day.